Good evening, ladies and gentlemen. I'm Leslie McCormick, Senior Wealth Advisor with the Farwell Group, and on behalf of our entire team, welcome to our annual Outlook event. Our agenda for this evening will start with Darren Farwell presenting our team's outlook for the year ahead. As is our tradition, following Darren's presentation, he will moderate a panel with two esteemed guests. Before we start, I'd like to properly introduce the members of our team. And starting, I guess, at the front here, we have Andrew McCall, one of the advisors on our team, Lisa De Silva, Jessica Farwell, Rhonda Agrippa, and our newest member to our team, Troy March, Sharon Fung, and our advisory team, we have Patrick Ross, and Eddie, and of course, here this evening to present is Darren Farwell. Darren started his career with McLeod Young Weir in 1987 and set out to build what is today the Farwell Group, one of Scotia McLeod's top advisory teams, advising on approaching $1 billion in assets for clients and their families. Our team is dedicated to helping our clients achieve those things that matter most to them by providing planning, investment, banking, and tax-efficient strategies to make it happen. Please join me in welcoming Darren Farwell.
Thank you, Leslie, and hello, everybody. Welcome back. I mean, one of the things I love, I'm looking around and I know so many people here, which is wonderful. And a lot of people I recognize from last year, and there's quite a few faces I know were here the year before that, and the year before that, and literally for all the outlooks we've done, which have been quite a few. In fact, a dear client of mine came in earlier, and we were trying to figure out whether we'd been working together for 30 or 32 years. We weren't exactly sure. You know, we used to have at Scotia a tagline, relationships for life, and you know, I think that's a good way. You know, it represents really how we feel about things. Anyway, it's an honor to me that you've come back, and those who are here for the first time, some from the far north. I hope that we can deliver something that you find of value. So yes, welcome back. And I know from the faces that I see here that there are people with very busy schedules, and that's just another reason why I really want to express my appreciation, my respect for you taking time out every evening to come and share the evening with us, have a little, those appetizers were good, some good appetizers, maybe meet some people, but most importantly, get some insights, you know, some insights on things, well, that will affect your portfolio and therefore have an impact on your wealth, not only just today, but longer term. So with that, what are we going to talk about today? Should have put that one up first. I love that cartoon. I think it was from Leslie. When is the bull market going to end? So today we're going to go through the agenda of, I'm going to provide some nuggets of what they call, you know, what collectively is called conventional wisdom. And I'm going to talk about how some of these ideas, these nuggets of conventional wisdom connect with what's going on today. Then we're going to look back at 2019. We'll take stock of where we are today. I'll provide an outlook of what we see happening in 2020. I'll summarize how all of those things tie in with the conventional wisdom we're talking about. And then very importantly, we've got two great panelists today, real masterminds of the Canadian investment business who are going to be here with us today. I'm looking really forward to that. At the end of that panel conversation, we'll have a Q&A. Really, we're not going to have much time for Q&A, 1, 2, 3 questions, but there will be the team, myself, and others available afterwards, and so feel free to ask us questions then. Conventional wisdom. So I said at the beginning that I was hoping, and my objective is to provide some insights into what's happening today in the market, what happened last year, and what to look out for. And the insights that I'm going to draw on aren't just the 34 years that I've been in the business, most of which was at Scotia McLeod. And frankly, I went to university and got a degree that touched on stock valuation, although it wasn't such a big thing back when I was in university. And then before that, I used to sit with my father on the weekends and he would go through the stock pages. I always made me very curious because he seemed to lose as much money as he made. And I wondered how all of that worked. Why would one be investing if you weren't actually making money? It didn't make sense to me then. Anyway, I'm not sure that it makes sense now, but not just that insight, and not just the insight from Leslie announced or was introducing our advisor team. There's over 70 years worth of experience on our combined advisor team. Not just insights from that group, but also the two very esteemed and specialists in their field of investments. But also the collective wisdom of all the investors who've been investing in the market for as long as there's been a market. Those insights collectively are this conventional wisdom. So I'm going to share some of those ideas, those conventional wisdoms, and relate to how they're impacting the market today. So what's the first pearl of wisdom? The conventional wisdom. It's time in the market, not timing the market, that creates long-term wealth. Now, I heard this from a client who's actually here today when we were talking later in the year, and it was clear that 2019 had been a very good year. Quite frankly, I've heard this statement, or one like it, 100 times. I've heard 100 different versions of it. You guys have probably heard versions of that statement. But for some reason, when he said it on the phone, sort of a light bulb went off and I went, what a year, 2019, to actually be the perfect representation of what this means. How important it is to just be in the market, because you never know which year is going to be the good year. Who remembers that period? September 2018 to December 2018. Quite a dramatic time, as a matter of fact, because on December 24th, the market, intraday on December 24th, was down slightly more. Andrew could tell you exactly, but it was 20+%, but 20.49%. That's a bear market. That's big news, because if we're in a bear market, it's saying that there's a recession coming. But actually, the market didn't close there. The market closed at down 19.7. Not a bear market. Very exciting, interesting, but sitting there in December of 2018, was we thinking that 2019 was going to be a year of great profit? No, we're thinking that 2019 was going to be a year that was going to be one where we might even lose more money. Didn't turn out that way. Who would have known? Well, actually, I did a little bit. We'll see that in a minute. But really, it was not the consensus that 2019 was going to be a very good year, but it was. You don't know when the good years are going to happen, and the only way to really share in it is to be there when they do happen. You've got to be prepared. You've got to be ahead of the wave. We'll talk about that some more. It's time in the market, not timing the market, that creates wealth over the long term. So let's look back at 2019. It was a hot year, a red hot year. My forecast, when I stood here last year and said, what will 2019 look like? I suggested it was going to be a melt up with the ever-present possibility of a meltdown. Yes, I know what you're thinking. People on this side of the business are always, hedging their bets. But there's no choice but to hedge your bet right now. Because while we could see that there were factors in place that could potentially make 2019 a very good year, as you'll see in coming slides, we're late in the investment cycle. And because we're late in the investment cycle, we can have a meltdown at any time. We'll talk some more about that. But as we see, What actually happened? Well, it was a very good year. That's what actually happened in 2019. TSX, very strong returns. You'll notice that in the US and international, we've kind of got two numbers. One, the first one, is the number in their domestic currency, and the second is translated to Canadian dollar. So that relates to further down the chart where you see the Canadian dollar did actually rise last year. A real reverse of trend, what had been for the last number of years, the Canadian dollar finally starting to get a little bit stronger. Well, it was a combination of the Canadian dollar getting stronger and the US dollar getting a bit weaker. But the Canadian dollar rose. Good returns, spectacular returns, right across the board. Canadian dollar went higher, interest rates went lower. Interest rates in the United States went dramatically lower. Interest rates in Canada really stayed the same, and the price of gold went up. Now, the price of gold, it's a store of wealth. When the US dollar declines and interest rates decline, there isn't a big opportunity cost for owning gold, so people will own more gold if rates are low because you don't have to give up, getting interest if you left it in cash or GICs. So that's what actually happened in 2019. Now, how did our numbers stack up versus what actually happened? All right, I did say that I thought we would have a good year. If you look at the numbers that I'd forecast, I did suggest that there was a good chance of getting high double-digit numbers last year. Certainly well below what actually happened. The markets ended up doing significantly better than what I expected, but we did think that we were going to have a good year last year. When we look at the dollar, we also thought that the Canadian dollar would rise, which it did a bit. Interest rates, however, were the big difference. Interest rates, as you could see, we were forecasting to go a bit higher. And as a matter of fact, you can see interest rates, particularly and most importantly in the United States, went down. So what were the factors that caused the market to do substantially better than probably we would have thought sitting here in January of 2019, but also even then my positive forecast? Why did we do even better? Well, if you remember 2019 at the start of the year, we had a couple of risk factors facing us. There was Brexit. That was still all over the map. No one knew what was going to happen there. Well, we got some resolution. It's not totally resolved, but at least there's a direction. There was the trade talks, the trade wars, we'll call it trade wars, trade talks with China. Tweets going back and forth, news stories changing. You never knew what was going on. And it is true that if the talks had really gone badly, it would have had a negative impact on corporate profits, would have had negative impact on global growth. It had been bad for the stock market. So we had reason to be cautious around what was happening with the trade talks. So those were important. And now, as we got through the end of the year, we sort of had some resolution on those fronts. Two other things were really important in 2019, though, that caused these numbers. And number one is corporate profits continued to increase. And number two, quite significantly, interest rates went down. One of the reasons why the market did so poorly between September of 2018 and December of 2018 was the view that Federal Reserve was going to raise interest rates. Instead, they lowered interest rates. Why is that so important? Why was that so important? Well, that takes us to another conventional wisdom. Don't fight the Fed. What does that mean? I'm going to connect the dots on this one. So I think it's really important. And that is, one of the things that you don't read a lot or hear a lot about is that the stock market over time, and this isn't a conventional wisdom, this is really a fact. The stock market over time is 100% correlated with corporate profits. If the corporate profits are going up, the stock market goes up. If corporate profits are going down, the stock market goes down. If the forecast is that corporate profits are going to go up, then the stock market will go up. If the forecast is that corporate profits are going to go down, the stock market will go down. Okay, what does that relate to interest rates? Well, when the Federal Reserve in the United States says that we're going to lower rates or maintain low rates, what it's saying is we want to stimulate the economy. We're interested in making the economy grow. We're going to push the economy along. Well, if they're stimulating the economy, then that means there's more demand in the economy. If there's more demand in the economy, that means there's higher prices. And if there's higher prices and borrowing costs are lower, guess what? Net, net, more profits for companies. More profits for companies, 100% correlation, stock market goes up. What happened in 29? All of those things. That's what happened in 2019 because we started the year thinking that interest rates would go up. Instead, they went down. So Bill Gross, one of the most famous and successful managers of fixed income and interest rates in North America over the last decades, says quite clearly, if interest rates are going to stay low, market's likely going to do well. Other real assets will likely do well. Also, I'm not an expert at all on real estate, but I'd venture to say that if interest rates stay low, real estate will probably do well also. So, interest rates, key. What is the Federal Reserve saying about next year? Sounds like they're going to hold the line. We don't hear many hints about them raising rates next year. Of course, they can change their mind. All right, that's why last year ended up being such a surprisingly good year. I mean, I don't know about, well, perhaps a lot of you here do get quite excited about the stock market. I mean, I absolutely, the stock market has everything. It's got excitement. It's got villains. It's got people who get rich. It's got mystery. It's got art. It has science. It has math. It's open all the time. It's global. I mean, the stock market has everything you could, I mean, it's so exciting. If the stock market had a body, I think I would marry it. The stock market is, and so I love this kind of thing because when you look at the stock market over the long term, it really makes sense. So let's take stock of today. What's going on right now today? Well, first off, you can see from this graph, it's the longest bull market. Well, that's interesting. Also, I know many of you have seen this graphic over and over because it's kind of my gospel of my stock market Bible, but this is updated. Look, we're getting very close to not only the longest bull market, but the biggest increase from the bottom. Getting very close. Okay, so what this says is that we're late in the investment cycle. One of those red lines is coming. I could have saved myself a couple of years of business school fees just by looking at this chart and going, okay, the stock market goes up, and then the stock market goes down, and then it goes up again. But what it doesn't tell you here or anywhere when you're late cycle is just when is that going to end? There's nothing there that tells you anything about when it will. And at the end of the day, bull markets don't end because they're long. There needs to be some catalyst for it to turn from a bull market to a bear market. Here's another way of looking at where we are in the investment cycle, and it leads me to another conventional wisdom. And that is the stock market climbs a wall of worry. You know, there have been a lot of things going wrong in the world since March of 2009, which was the bottom of the last Great Recession and the start of this bull market. A lot of things have been going wrong, yet the market keeps going up and up and up. It climbs the wall of worry. And it particularly climbs the wall of worry under a couple of circumstances. One, we know for sure for the market to be going up, corporate profits must be rising. Corporate profits have been rising consistently. Number two, we need to have low rates. Well, we've had low rates, and we've got even low rates seem to be staying low. And then thirdly, we have to have a lot of people who do not want to be invested because it's too risky. And why is it important to have everybody scared of investing? Because if everyone really is, by and large, afraid of investing or scared of getting too invested, that means stock prices won't get overvalued. Stock prices are at good valuations. So there'll be a constant demand for stocks at fair valuations, and the market just goes higher and higher and higher. That's been the case now for a long time, as you can see. Back in 2016, there was a big change in the market, similar to what happened last year. In 2015, the Federal Reserve said they were going to raise rates. In 2016, the market went down, and then after that, they said, no, we won't cause recession by higher rates. So the market's been on this phase 5 going up ever since. And whatever the headline was, the market seemed to recover and keep going higher because corporate profits have been rising, interest rates are low, and people are afraid to invest. You know, in 2019, investors as a whole bought more bonds than stocks. People are scared. That's good for the stock market. Now, I'll say though, we were talking to someone earlier here today who made a very astute observation about, I'm starting to sense a little bit, it's early, in the media and conversation, more discussion about how stocks are going to continue to go up, how stocks are really a good place to be, and you got to own stocks. I haven't been hearing that for a long time. I think what we're seeing is the very early stages of moving to a different level here. One of the things you don't want is exuberance. Because when you get exuberance, when the headline in the newspaper says, if you don't own stocks, you're an idiot. I know that sounds funny, but we've seen headlines in previous cycles that look just about like that. When your taxi driver and your hairdresser start recommending the best stocks for you to own, it's getting late, and it's time to think about whether or not there's exuberance. And if there's exuberance, that's probably much closer to the end. So we're already well past where the consensus was that we would move from a bull market to a bear market. But again, there's nothing there that says when it's going to end. Back in 2016, I put 2021. We'll see. That's after the next federal election. Can't have a presentation about the economy, particularly in the United States, without saying something about the president. He definitely is a point of conversation at parties, coffee shops, work, and just about any place you go. But one thing that President Trump has said is that he wants to be the president that ushers in the highest return in the stock markets of any president. He said that. And whatever we think about Trump, I think one thing we could probably agree, he's reasonably determined. And if he actually does that, there's a long way to go. But if he succeeds, there's a lot of money to be made in stocks still. We'll see. Remember, though, it's late cycle. I said earlier, when you're late cycle, when you're way up there, anything can happen to make it go the other way. The professor emeritus at Wharton Business School says the number one determinant of risk is where you are in the investment cycle. We're late in the investment cycle. The risk is high. Doesn't mean you won't make money over the next few years, but it does mean the risk is high. And when the risk is high, what that means is it's kind of like any straw could break the camel's back. Well, is it coronavirus? I don't know. Short term, the market has stumbled, but short term, the market's just waiting to see how serious is this. Because if it's really serious, then, yep, that's going to be bad for the market. We'll see. Certainly want to be cautious and stay tuned, though, because it'll be that simple to change the direction of the market. So what does all this have to do with you and your investments? Well, if you're a long-term investor with long-term savings and you're not particularly upset by market volatility, it doesn't mean anything. It's just interesting noise because you'll ride through it. However, many people, market volatility emotionally is a little more difficult, so we'll have to think about what to do about it. I love this chart, goes a long way back on the US market. We've been developing a big wave in the US market. Okay? It's a long way up. We know one day that wave will break. And just like the surfers, the surfers are riding the wave, but they always have that thing attached to the board, so when it does ultimately break, they're okay. They still have the board. I'm looking around the room. I've met a lot of you, and I know the other advisors on the team have met you as well. We're prepared. We were getting prepared in 2019. We're ready for whatever happens. So at this point, because you do want to be prepared ahead of time. Do you remember December 2018? When it crashes, it happens too fast and with so much force, it's too late to get off then. You've got to be prepared ahead of time. But we're ready. We are prepared. The next bit of conventional wisdom is it's good until it's not. It's rising, it'll keep rising until it stops, and then one day it'll be different. And for that time, you have to be prepared to make sure that the income you need to live on is safe on the sidelines. Make sure any big lump sum of money that you're going to need for something in the short term is safe on the sidelines. Otherwise, with your long-term investment money, get invested, stay invested at the level of risk that's comfortable for you. So what's our outlook for 2020? Well, the surge in 2019 has certainly suggests that there will be technical corrections in the market in 2020. There'll be consolidation in the market in 2020. All of that will dampen the mood a little bit. So while we're still looking at positive returns, they're much more modest. So single-digit returns. Still think the U.S. market, even though there may be a shift from growth to value stocks, so there'll be sale of growth stocks and purchase of value stocks, U.S. market is likely still to be the best market in the world, but other markets like Canada and international markets will be very close because even U.S. investors will start looking outside of the country to find their value stocks. Okay, so, but still good returns in equities, better than in cash and GICs, but with risk. It's late cycle, so there's risk. But let's face it, the only reason why you get longer returns in stocks over time is because there's risk. Embrace the risk, because that's why you get higher returns. If there was no risk, you'd get cash rates of return. So stock market's doing well. Canadian dollar, I think Leslie has said to me a few times, parity is something like to 80 or 82 cents. I don't think we're going to get to parity, but a combination of a weaker US dollar and Canada being okay, I think we'll get a little bit more strength in the Canadian dollar. Interest rates, Scotia is saying 1.8% on the 10-year US. It's actually lower than that right now. There's a real question whether coronavirus is going to slow down global growth or not. We'll see. But anywhere, 1.8 at the end of the year, not very far off where we are now. Canadian and Canada looks like the consensus is we'll cut rates 2 times. So borrowing should get less expensive in Canada. So that's interesting. And gold, again, a little more expensive. So that's the outlook for next year. Modest returns, high single-digit returns in equities, still a good place to be with your money that's got a long-term investment goal. I don't like to finish my presentation off without talking a little bit about, or restating rather, the power of dividends. The power of owning high-quality dividends from high-quality companies. There it is, the mothership, Bank of Nova Scotia. Okay, maybe it's not the best bank stock out there or hasn't been in the last couple of years, whatever. That's a pretty good 20-year average annual rate of return and tax effective because of the dividend. So yeah, just put it out there. So very good. The power of dividends is very strong, particularly if we're late cycle. So to summarize, timing the markets, not timing the markets. Long-term wealth is created by investing and staying invested over the long term so you capture those years where you have extraordinarily high rates of return like 2019. Markets climb the wall of worry. A good time to be invested is when other people are really scared of the market. It gets a little more dangerous and vulnerable when everyone wants in. Don't fight the Fed. We'll be watching interest rates. If the Federal Reserve starts to hint at the fact they're going to raise interest rates, that will be a very serious sign that probably the market may go the other way. It's all good until it's not good. You just don't know. That's why you've got to take the long-term perspective, but make sure the money you need is off to the side. And I'm going to add this one, which I haven't talked about, which is buy when everyone else is selling. Remember that bull-bear chart, red line's coming. At some point when we hit that red line, it's a great time to buy. So what I'm going to be talking to people about over the next year or 2 years is getting ready for that opportunity. We're already prepared for the market going down. We've done what we need to do. We're ready. We've been through it before. But when the market does go down, it'd be nice to be able to take advantage of it. There'll be real opportunity to buy when everyone else is selling. So now I'll ask Leslie to come back up because she's going to introduce our 2 panelists today. It's been a pleasure. Thank you for taking the time to listen. It's been a pleasure speaking with you and look forward to meeting you all individually and talking about that opportunity when it comes up.
This year, we're pleased to have Andy Nasser, Chief Investment Officer of Scotia Wealth Management, and Noah Blackstein, Vice President and Senior Portfolio Manager with 1832 Asset Management, on our panel to share their thoughts. Andy is a CFA charter holder, is an award-winning portfolio manager with approaching 20 years experience in investment management and investment strategy. Andy joined Scotia Wealth Management's Global Portfolio Advisory Group in February of 2018 from a private investment firm. He brings a breadth of experience across fixed income, global and domestic equity, real estate, infrastructure, and healthcare, and has been featured as a recurring guest on BNN's Market Call. And here, who may need to do the heavy lifting tonight, is Noah Blackstein. He manages over $5 billion in U.S. and global growth portfolios for Dynamic. Alongside his mutual fund mandates, Noah manages 2 hedge funds, Dynamic Alpha Performance, which is a conservatively managed hedge fund designed to protect capital and wealth, and Dynamic Global Growth Opportunities Fund, which is managed with the goal of delivering superior long-term returns. Noah has a proven 25-plus year record of investment success and is the recipient of numerous industry awards. He has regularly appeared in many well-known publications, including Barron's, The Wall Street Journal, and has been a featured guest on CNBC and other respected financial news programs. So thank you, Noah, for being here, and hopefully Andy will be able to join us very shortly. We're privileged to have you here this evening, and thank you for making the time to join us and your willingness to share your thoughts and insights.
No, as we've discussed, markets have been pretty good to investors over the last couple of years, particularly in the United States. Where do you think we can go from here? Is there any fuel left?
I think so. I think, though, as we look into 2020, I think, I've been doing this for a long period of time. I joined Dynamic in 1997, and I've been running the same U.S. fund since 1998. So July will be 22 years on the same fund. And so obviously I've been through quite a lot, two of the worst three bear markets in history. I would say, though, that if I look back from when I started in the early 90s, whether it was the 94 peso crisis or 97 Russian debt default or long-term capital 98, 2000, 2002, or 2008, the major catalyst for a large market break has typically been the Federal Reserve. A mistake by the Federal Reserve raising interest rates too much, whether that was in emerging markets in 94 or housing began to roll over in 05 and they kept raising interest rates. I'd say in this case, the Federal Reserve is off the table in 2020. They told us in 2018 they were going to raise rates 4 times, they cut them 3 times. They told us that they were going to run off the balance sheet, and they added $500 billion to the balance sheet. So with them not raising interest rates and not running off the balance sheet, I think that they've moved off to the sidelines. And so that risk, which is, for me, one of the bigger risks, has kind of moved to the sidelines. Having said that, though, the market went up a lot last year, and earnings went down, which means you had a large expansion in valuations. And so the question becomes, this large move in valuations, which companies are justified in having those superior valuations, and which companies are really just too expensive? So I think 2020 is looking like a year where I think the returns are going to be good, but I think they're going to become much more stock specific. I don't think it's just a general market as a whole. I think some of these companies really need to prove that they warrant or they're worthy of these valuations, and we really need to see the earnings come through. Now, in the last few days, the earnings have been very strong. Amazon tonight reported very strong earnings. Microsoft reported strong earnings. So we're seeing strong earnings come through, but I think that's what's going to keep the market going. We can't just sort of rely on expanding multiples like we had in 2019.
And so my approach to the market is a lot from an asset allocation perspective. So I've got a very top-down macro look at the market. Your style is more bottoms up. You look at companies. You're concerned about interest rates, but you look at companies.
Right.
And technology stocks have definitely been a fuel to help the market move forward the last year. Is there still room for technology stocks to go higher?
Yeah, I think in the technology space, we're still in the very early stages of what we would call the digital transformation and this move toward cloud computing. And so back in 2005, 2006, you had a company come public called Salesforce.com. It's an unfortunate name after the .com issues of the late 1990s. But Salesforce.com did customer relationship management software. But it was all cloud-based, so it was a subscription, and then you would use Salesforce.com. A lot of companies were using different systems like Siebel or Jana, or different systems for customer interaction. When their salespeople would call, or their inside salespeople, they would use a system like that. So the early days were basically, let's move to the cloud, let's put our app online. And that was very strong growth. And a lot of people said, well, the market's limited and people don't want their customer information in the cloud. But what we really began to see was, probably the landmark deal for cloud companies, I think it was sometime in 2007. State Farm, which I'm sure you all know, a very large company, signed a deal with Salesforce.com for well over $100 million, which was at the time one of the largest deals for cloud computing that we've ever seen. And if you asked what State Farm was using before, it would be shocking. They weren't using a CRM system. They weren't using a customer relationship management software system. They were using Excel spreadsheets. So if you think of a firm the size of State Farm that was having all their customer, this may be why you can't get anybody on the phone when you call your insurance company. I don't know how they think. Rogers might be doing the same thing. I don't know. Anyway, but they were using that. So this wasn't like, oh, what's the addressable market and how big could the company be? This idea that all the technology resides at another company and I just have to subscribe got them to move towards the cloud. Now we're at a point in time where companies are now beginning to say, and you saw this tonight in Amazon has a business called Amazon Web Services, where companies rent cloud space. They use their computer infrastructure instead of their own. Microsoft has that with Azure. Both companies reported very strong numbers. But we've reached such a size and scale that what we're beginning to see are companies now viewing technology as a revenue generator. So if you talk to anybody at the Bank of Nova Scotia, for 40 years, they would say computers are a cost. It's something we spend money on for processes, for compliance, for whatever. But now, what companies have seen is the success of Google and Facebook. And so, for example, let's say, for example, I decide to buy a bathing suit tomorrow. I apologize, you've all eaten,
Yeah.
so
A little early in
a
the
little early
season,
in the
Noah.
But what should happen when I buy that bathing suit? Well, what should happen is if I use my Scotia Visa, I should immediately get an email from Scotia offering me a travel rewards visa. Because clearly if I bought a bathing suit in January, there's a small probability I'm crazy, but there's a much greater probability I'm going somewhere. And then the second email should come from Scotia Insurance, where they're offering me travel insurance because, out-of-country healthcare costs. Now, that's something Google and Facebook will do. That's something that they've learned how to mine your data. But it's something that these larger companies haven't learned how to do yet. And so they're just beginning that. So $1.7 trillion is spent a year on technology, and only 160 billion of that is on the cloud. So I think a lot more is going that way. But it's going to become a tougher market for maybe some of the older technology companies, perhaps an Oracle or an IBM. But some of the companies that are helping this move towards the cloud and are helping bring machine learning and artificial intelligence, and now beginning to say, I just met a company in New York last week, and they have software for call centers, call centers aren't a great business if you think about it. But imagine if you had thousands of calls coming into your office every day, and what they're basically going to be able to do is takes all those voice calls and translate them into text. Now, I know you hear often this call is monitored for quality assurance. It's not. And now, no one's going to read the transcripts either, right? But let's say, for example, in your case, let's say, all the calls came in from clients, and now you said, you know what, I'm thinking about having an evening on perhaps wills and estates. I'd like to do just an information session. I'd like to search every client that's called and had a conversation in our office on wills and estates over the past 2 years. And because you have that all in text, and now it's like a Google search on top of that, because the system resides in the Google Cloud, you can pull up everybody that's called in. So instead of having 100 people there or sending out 500 emails, you may now have a group of only 30 people, but 30 people who actually care, right? And so that ability to mine the data and manage the data, those practical implications, that's just sort of beginning right now. I think Google and Facebook have shown people how you can use data to make better sales, and I think that process is just starting. I think it's got a long way to go.
Well, that's why we have you here. You really know your stuff in that sector. Is there, outside of technology, do you see things that are interesting, or are you focused primarily on technology?
No, I'm focused on anything that's growing, and for most part, that's been in the technology space. But technology is very different than it was when I started in the 90s. In the 90s, it was all about a personal computer on your desktop, and then it was the Intel chips inside, or the Micron memory, or the Western Digital hard drive, or maybe it was the 3-comma Cisco networking computer. Everything was tied towards that PC. Now technology is a platform. So if you're Lululemon or you're a retailer, you have to have an online strategy. If someone comes into the store, they don't have it, the person that's helping you needs to be able to order online immediately, right? You always have to have this digital strategy. If you're a media company, even now Disney and NBC have gone into standalone apps to compete with Netflix. And so technology is no longer a product or a piece of hardware. It's sort of a platform in terms of how people access media, access travel, access a whole bunch of things. So I would say that we look for areas that are growing, and that's certainly growing. I would say last year, one of our bigger successes has been in the healthcare space. Despite Bernie Sanders and Elizabeth Warren specifically hurting the healthcare sector in the US last year, a few companies we've owned were acquired. That's pretty substantial premiums. And what I would say is that we're seeing in the US, we're seeing two things that are fairly exciting to me. It's interesting with I remember very clearly where I was when Magic Johnson announced that he was HIV positive. I was at University of Toronto. I was still a young kid. And I remember, if you grew up in the 1980s, it was like, well, that's just terrible. I mean, how long? He's got a few years to live. And we did an event in Santa Barbara in 2015, and the guest speaker was Magic Johnson. And Magic Johnson, you can see him on TV and all these tributes to Kobe Bryant after that tragedy. So why is Magic Johnson still alive? And that's really because in the mid-1990s, they came up with this cocktail of HIV drugs, where they combined 3 different drug therapies. And so you're never actually cured of HIV, but you've held the virus in check to almost undetectable levels. And so a man born today who stays relatively healthy and takes his medication has almost the same life expectancy as a man who doesn't have HIV, which is pretty incredible. HIV is now treated almost like diabetes versus what it was in the 1980s or 90s. That concept of using multiple drugs is really beginning to take off in oncology. And so where you can combine different drugs together to say, we all hope and pray for a cure to cancer. It's one of the most horrible, and I'm sure everyone in this room has been touched by it, including myself. But where you can combine drug therapies to say, if we use 2 of these drugs or 3 of these drugs in combination, is there a way to, maybe we can't treat it, but maybe we can hold it at a stage 1A or a stage 2A. Maybe life expectancy could go from 3 years to 7 years or to 10 years. And there's amazing data coming out. And I think that's why there was so much M&A, especially in oncology. It's all about the combination of these drugs. The longer term opportunity is this technology you may have heard of or may not have heard of called CRISPR and Cas9, is where there's a couple of different ways to do it, but it's repairing genetic defects or the ability to take the DNA of the tumor out, put it into a weakened flu virus, have your immune system identify it, and then the biggest problem with cancer is your body doesn't know it's there, and have it identify and attack it. That's much further along. That's more of a 10-year story than a today's story. But combination therapy in oncology, in terms of the results we've been seeing at the American Society of Clinical Oncology and stuff like that, there's some very, very exciting stuff. And so, we had Loxo Oncology acquired for a 65% premium. We had Array Biopharma acquired by Pfizer for a 65% premium. So there's major work going on in combination therapy. It worked in HIV. It's actually working in cystic fibrosis. It's a company called Vertex Pharmaceuticals, which has now come out with the triple. The first cystic fibrosis drug was okay. The second cystic fibrosis drug, used in combination, was better. The triple combination has had dramatic impact on the lives of cystic fibrosis patients. So we're seeing combination therapies really beginning to become the standard of care. And obviously in oncology, that's a big opportunity.
So when you're dealing with companies, clearly you seem to be that are in a growth mode, that are growing, then they tend to trade at higher multiples than the market.
Sure.
Which would make me wonder or think that they're likely going to come down more than the market when the market goes the other way. What do you do as an investor if you've got new money? Can you be comfortable investing in a fund that's investing in those kind of growth companies?
I mean, everybody's a 10-year investor, but it's pretty much 1 month at a time.
Yes.
And I've been doing this for a long period of time, and I've gone through some big market breaks. And I would say, the lessons of 2000 and 2002 and 2008, even when those market breaks came, our fund went to new highs long before the market went to new highs. And whether that was finding, in 2002, whether it was a Genentech or Whole Foods Markets or eBay or coming out of 2008, I think in October of 2008, Apple traded to the price Apple traded at in 2008 was equal to what they earned 2 years later. So they basically traded at 1 times earnings. So we do a lot of work on valuation, trying to figure out how much bigger the company can be and how much faster it can grow. But really, we're trying to find, when Google came public, it was doing $1.8 billion of revenues. And the estimates were for $3.45. And our question was, $600 billion a year is spent on advertising globally. Less than 2% of that goes online. If 10% goes online, it's a $60 billion market. And half of that search, could Google do somewhere between 10 and 20 billion of revenue? And the answer was yeah. and what would they earn on that? And it was anywhere between sort of $25 and $35 a share. That's a far cry from $3.75.
Yeah.
But 5 years later, that's about what they earned. Facebook, when they went public in 2012, 6 months later, stock got cut in half.
Yes.
After the IPO.
Remember that.
And it was like, if you did the same sort of work on Google on Facebook at $21, you came up with sort of $7 to $9 a share of earnings power 5 years out. Well, if you think about it, Facebook went from 21 to 220. And that earnings power is about $10 a share now. So I didn't know if the market would pay 10 times earnings for Facebook. But if they did pay 10 times earnings for Facebook and it was a $7 number, it was a $70 stock. If they paid 20 times, it's 140, or if the upside scenario was 180. So there was a substantial amount of upside if they could sort of replicate what Google had done 7 years earlier in terms of capturing market share. And obviously, they went well beyond that in terms of both those companies. So our valuation work is not, anybody can look up a P/E ratio in Yahoo Finance. You don't need me to do that for you. What we're trying to figure out more is 5 years from now, where can this company be? When I bought Apple, I bought it at 38 times earnings. And 3 analysts covered it. And when I sold it, the entire world covered it, and it was trading at 11 times earnings. And I know that's the opposite of what most people think. And that's because the earnings went up so much more than the stock price. So we look at valuation in that context, that a company is worth what its future earnings are, and we're comfortable with the companies we own. I think the problem becomes if you own a company that's not growing and you're paying a high multiple, the problem becomes you've really overpaid for that asset. And so that's sort of the market we're in a bit today. You really need to do the work on individual companies to make sure you're comfortable with the growth and the valuation relative to that growth, because a lot of stuff went up that last year. And I think it's going to be trees and forests in 2020 for sure.
So when we were talking about how it's time in the market, not timing, when the market really goes down, you're going to be getting some great deals on some really high growth companies to set you up well for when it goes the other way.
Right. And so, I think one of the more interesting things that I've seen, I'm now, in April I'll turn 50. And I know what you're all thinking, that's impossible. And
You look very young for 50, Noah.
Well, remember, I started running money at 24. So for about 10 years, I told everybody I was around 30. Because nobody would talk to me when I was in my 20s and running money. And my photo was terrible. I looked like a bar mitzvah photo on my, so it was very hard for people to take me seriously when I was in my 20s running funds. But anyway, here I am at 50, and I look the same. I'm of the vintage now where my first daughter is now off to university. It's her first year of university. She broke my heart and went to Queen's instead of the University of Toronto, but that's okay. That's what daughters do to their fathers. But there's a lot of advisors and people I know who are sort of around my age and have their children going off to university. And these are people who in the RESP programs, maximize it with just put 100% Power American or Power Global, one of the funds I run, and they never really looked at it. And I've had quite a few people in the last year come up to me and basically say, you've paid for my kids' entire education. Like, I don't have to worry about where I sent them. So whether it was McGill or Western or Simon Fraser or UBC or Toronto, that sort of makes it real. And so for the people who have been able to, buy and not worry about it and know the longer term growth skates us on side and the trajectory longer term of the markets is up, they've been able to do extremely well. For the more conservative investor, we have funds like Alpha Performance, which are obviously much more conservative, use the short side of the portfolio to manage volatility. That's for a much older client who's just looking for that mid-single digit return with low volatility. But for the 40 and 50-year-old who has a lot of years, or for the RESP client who have 20 years ahead of them, it drives me. I saw a portfolio once of a 30-year-old in the Globe and Mail. They used to do this thing. This person's 30 years old, and they had all of these bonds and preferred shares. I'm like, you're 30 years old. You have 45 years of investing. Put the pedal to the floor. The time is your friend, and it'll work for you. So I think asset allocation is time dependent. That's why we rely on people like you to know your client, to do the right allocation. But I do think that there are some secular opportunities out there for sure, longer term. And we've done very well over the last. We started in 1998. If you pick up the Globe and Mail, they'd probably say I didn't exist. But we've more than doubled the S&P 500 return over the last 21 years after fees. And that's only by sticking to our discipline and process. In terms of what we do, we don't pay attention to the index or anything like that. Our portfolio looks much different than the overall index, and we just sort of focus specifically on what we do.
Okay, well, in the interest of time, I just want to say that your daughter's staying in Canada, so actually you're pretty lucky. My daughter went to Scotland, so my university was paid in British pounds. So I really could have used that additional growth to finance that.
I'm fairly certain you could have. I was around, but you can't use an RESP in Scotland, is that right?
Yeah.
You could?
No, you definitely can use the RSP out of the country. Yeah, as long as it's a credit.
At least the British pounds collapsed.
So it didn't collapse when she was there for me, unfortunately. So one more quick question. Already said interest rates.
Yes.
Something to watch. Anything else that people should be watching for when they're thinking about 2020?
I think, I realize coming to this event that you're hosting, I'm supposed to flatter you.
And you haven't been doing a great job so far, no.
I understand that, but what I would say is that your role is extremely important right now. And especially given where bonds are, I think asset allocation is going to take a much more unique strategy in terms of how you position portfolios, how you find assets that can work within those portfolios. So I really do believe that it's going to be an interesting market in terms of bonds aren't returning what they used to return, and how you structure portfolios and stuff like that. I mean, I do what I do, and how that fits with you and your clients, that's one thing. But I do believe that you really need, it's a worthwhile conversation to sit down with you in 2020 and 2021, making sure the asset allocation is right and that you've structured portfolios properly. Because I think now is the most important time to make sure that you're positioned properly in terms of whether it's corporates or governments or high-yielding equities or alternatives or whatever it is. That it's really important to make sure that you're structured properly. You might have said that or not, I don't know.
Well, last year we talked about alternative investments as a way of actually protecting the portfolio a little bit without getting so conservative as bonds or GICs. Thanks for your time, Noah. Andy, outlook for 2020. What are the things? What are the opportunities, and what should we be watching to be careful of?
The way that we'd characterize 2020 and even the next couple of years is that we are close to the end of the business cycle. And it's not necessarily that it's an ominous end, it's just that the business cycle continues to mature, which translates into growth that is more difficult to come by. So in that context, we want to make sure that we are prepared for any mean reversion as it pertains to an increase in volatility, the portfolios are properly positioned, and that they are well asset allocated, which is a comment that Noah made. And that's really the most important thing. Generally, when most people think of asset allocation, they bifurcate it into two major categories. There's equities and fixed income, and those asset classes can perform very differently. Equities being tethered to corporate profitability, so anytime we get concerned about the visibility of corporate earnings growth or the likelihood that it's going to materialize, we see equities bounce up and down. With fixed income investments, where if you own fixed income securities, you're lending money to somebody, so they tend to be much more predictable and stable asset classes. It's the combination of equities, fixed income, commingled with things like alternative investments, which have a relatively low correlation to the other two asset classes, that can help protect capital and ultimately allow us to make tactical asset allocation decisions that compound at a much higher rate going forward. So as we look to 2020, I think that increase in volatility could present us with very good opportunities to make those tactical allocation decisions, especially considering how buoyant the market has been, seemingly shrugging off a lot of geopolitical risks and concerns that could potentially become a little bit more amplified as time goes on.
Thanks, Andy. Any thoughts about interest rates and whether you feel that interest rates are likely, the Federal Reserve will maybe change stance and rates will go higher? What do you think the probability is of that?
Yeah, so it's a great question, Darren. It's important to distinguish between short-term and long-term interest rates. So generally, when central banks move interest rates up and down, what they're doing is, in fact, affecting a change in short-term interest rates. And that doesn't really change the output potential of an economy. And when we say that, that's how much the economy could produce if it utilized all its available resources. When they move short-term interest rates, they're really pulling growth forward or pushing it back. Importantly, what we care about as investors, long-term interest rates, because that's what we use to ascribe value to assets. If you buy commercial real estate, you're discounting cash flows from a building. You're doing that using long-term interest rates. The price of a bond is the equivalent of the discounted value of all the interest payments you're going to get. And it's the same thing with equities, except we use PE multiples as a pretty lazy way to discount fair value. But long-term interest rates matter a lot. And when we take that longer-term view of the global economy, there are no question that there are some constraints that are going to affect global economic growth, inflation, and interest rates. And they happen to be the excess indebtedness that is really encumbered governments, households, and corporations in a lot of different parts of the world. Public and private market debt to GDP has never been higher. That's problematic because if you think interest rates can go up and stay up, we have to be able to not just service our debt obligations, but repay them. So that's a very significant constraint. In addition to that, we have a demographic constraint that affects the out potential of economies. I talked about that being comprised of the ability to use all the resources within the economy. That means people and the goods and services those people produce. And as the global population ages, and it's going to age quite significantly with the number of people over the age of 65 projected to double over the course of the next few decades, that means that labor force growth is going to remain constrained, which limits our ability to grow our way out of the excess indebtedness that I discussed. So generally, when we look forward, we think that there are several factors that are going to, I think of them as a speed limit, be a speed limit when it comes to economic growth, inflation, and rates, which means that they likely head lower, notwithstanding the fact that central banks may want to increase interest rates at some point if it looks like the economy is heating up and we have inflationary problems that we need to deal with.
Good. Thanks, Andy. Okay, thank you, everybody. Come on out and have some refreshments and coffee.